About a few seconds. All right, you're live.
All right, folks, thank you very much for taking the time to join our daily webinar today. Enjoy the educations and ask questions along the way. Okay, we truly appreciate your time and attention to show you how boring successful trading can actually be when you have the right strategy. Many of our members make more than the cost of their membership during the trial, and the trading plan takes less than 2 minutes to execute at noon Eastern daily. Okay, call me, folks, with any questions at any time, 505-322-7515. And really, if you have any questions about the system, please ask them in real time during this webinar presentation, guys. It's going to be the best way for you to get the most value out of what you're going to learn today, okay? And make sure to save my number and feel free to call me with any questions after the webinar. And definitely save that number, folks, so you can call me or text me to set up your one-on-one coaching session with me as well. That's something that's offered to you as an added value and a $500 value during your free trial. Okay, folks, our system is based around Warren Buffett's top rules in investing. Okay, rule number one: never lose money. Rule number two: don't forget rule number one. Okay. This is so cool, guys, because literally from today until Thursday, you can quickly establish a hyper defensive portfolio. Just 4 ETFs, okay, that's all you're gonna need. Plus, you'll eliminate business risk by owning a stake in 1,500 companies with just 4 ETFs. Okay, trade alerts will be sent out via text message and email Monday through Friday. We engineer our positioning in coordination with the financial system and macro environment. Now, you might be asking me, hey guys, well, how do I by Thursday quickly establish a hyper defensive portfolio? Well, it's real simple. Today, if you don't have it, you pick up a 10% allocation in the EEM. Okay, that's the emerging markets ETF. Okay, tomorrow, and then you're obviously going to wrap options around it to give your capital even more security. Okay, Wednesday, you're going to buy the S&P 500 at a 40% allocation of your capital. Okay, you're going to wrap the options around it to add another layer of defense. Okay, and by Thursday, guys, you're going to pick up TLT and GDX, and you're going to use the options to protect those assets as well. Okay, literally within 3 trading days, you have a hyper defensive portfolio and more than 1,500 companies of the best on the planet. Plus, you have the best bond market on the planet on top of that to hedge your risks. Okay. Live video presentation, that's what we're in right now. Jason's going to fire that up in just a few minutes here. Okay, you can access the live presentation from our trade alert email we send out each day. Simply click the image that looks like a play button. Please ask any questions live during the presentation. Just click the icon to unmute your microphone or simply type it in the chat box. We look forward to addressing any question you may have during this presentation. If you're catching this on the recorded version on YouTube, feel free to just comment and ask questions, guys. Be more than happy to get to those in as fast as we can. Okay, and just remember, you can always review our track record at portfoliobuilder.io/track-record. Okay, or you can just go to portfoliobuilder.io, scroll to the bottom of the screen, hit track record. But we build trust with our clients by being 100% transparent with every position we've ever had. Okay, you can always access our track record, folks. Please do so if you haven't yet. Okay. Things you'll need to have in place to get the most out of your trial. Number one, a brokerage account set up to follow our trading plan that has options trading enabled. Okay, that's going to be important, guys, because you will need to add the extra layer of security with the option trades. Okay, you can use real capital or simply paper trade. Then you can see how incredibly easy it is to give your hard-earned money the protection it deserves. Okay, you're also going to need the ability to take 1 to 2 minutes to follow the trade alerts released at noon Eastern. These alerts are by no means time sensitive at all. They simply need to be placed before the market closes at 4 Eastern. Okay, you're going to need a mobile phone to receive our text message trade alerts. Many of our clients take these trades on the go from the airport, restaurant, in the car, anywhere they have service. It's important to make sure that you entered your cell phone number when you signed up for the trial. If you use a landline, email the cell phone number to Ryan at Portfolio Builder, or just hover your mouse right here and interact with him live, and he'll get that added in for you. Okay. When you chat in, just post your name, your email, and the actual cell phone. He'll get it added for you. Okay. You're gonna need an email provider that's in good working order. Okay. Current assets allocation recommendation per 300,000. We're gonna be 50% in equities. Okay, and that's gonna be represented by 40% of our capital in the S&P 500. That is absolutely where you want the majority of your capital for the foreseeable period. Next, guys, is going to be a 10% allocation or 800 shares into EEM. Don't outright go just buy these ETFs, guys. Wait for each trading day to pick them up. Okay, as you can see right here, we trade the SPY Monday, Wednesday, Friday. We trade EEM on Tuesdays, TLT and GDX on Thursdays, right? So literally from today until Thursday, you can have a hyper defensive atomic bomb proof portfolio, okay, and have options to protect you on top of just having a really well balanced portfolio. Okay. If you want to double that allocation, simply scale it up. You're going to do 400 shares of SPY, 1600 EM, 1600 TLT, 1600 GDX. Okay. If you didn't get today's trade alert and you're watching this after it's been recorded, just email Ryan at Portfolio Builder. Okay. Or if you're live and you don't have the trade alert in your inbox or on your phone, hover your mouse here to get support from him live. All right, Jason, with that, bud, I'm going to go ahead and hand it back to you.
Okay, great. Thank you so much. Let me go ahead and throw it on my screen here. So yeah, as Karen mentioned this morning, she's always got the best comments. Ray Dalio's out in Davos today, and his quote was, "Cash is trash." A couple other funny headlines I'll read before we jump into the trade alert. Hillary is in an interview saying nobody likes Bernie. And this is just comical. But in 2019, China's slowdown was blamed on the trade war. In 2020, it will be blamed on a virus. Just some quick stats on the virus spreading so far. We'll talk about why this could potentially. The last time we had a big virus like this was SARS, and this is spreading much slower. But the big fear here, guys, is that for stocks at least, let's see what we got in the chat box. Yeah, exactly, Karen. Okay, so here's the big concern. If there's a fear in Asia that puts demand on US treasuries, that means that the flow of debt will not end up in the primary dealer's hands and thus transferred over to the Fed. We all know the stock market rally is fueled by the expansion of the money supply. So if we only have 10 stocks in the middle of a circle and we all have $100 combined, well, we could calculate those stocks are on average worth $10. But if we double the money supply, well, then the relative value of those same 10 stocks should double. So the fear, at least early on, assuming that we don't have mass contagion and a real problem on our hands, is simply that this slowdown in the big fear here is simply that foreign investors will pick up the US debt this week, which could cause the Fed's balance sheet to either go flat or negative on Friday. So that'll be our key thing to watch this week. As far as what debt we have issued this week, we do have a lot of T-bills, and wow, that actually increased this morning. This was less. This was 76 billion, so now it's up to $80 billion. And they did go, wow, don't let a panic go. What's the old political headline is don't let a panic go unused. Well, they have dramatically increased the offering amount from 76 billion to 80 billion in the T-bills this morning when I had refreshed this just literally an hour ago. And they jumped the tips up to 14 billion. So that's very interesting. And once again, I'll be watching the auctions. The first one is going out Wednesday. And I see what this is. They did sell the 76 billion this morning. So we'll look at the results. But again, the fear is if foreigners picked up the US debt, that means primary dealers had an easy week and won't be passing as much of that debt on to the Fed's balance sheet, which will either potentially slow down the growth of the U.S.'s money supply, or potentially even decrease it. So that's the big concern I have currently. We have some earnings coming out this month, not a whole lot of data coming out. So really the biggest factor is to track the debt that's being sold versus how much is ending up in our primary dealers' hands. And then we can pretty much predict that around 90% in the last 3 months has been ending up in the U.S. balance sheet, either as a permanent addition or through the repo markets. Okay, so we just sold off a huge amount of debt today. The next big auction is on Thursday. So I'll take a look at that this evening and see what the results look like. Our put option pulled a 47% profit guarding the position, and had emerging markets tanked much lower, it would have really protected us even more than it did today. The net result was still a loss. We did give up 57 cents per share week over week on emerging markets. And that's after getting a 47% return on our put. So had we gone lower, our losses would have been cut off where we purchased the put option, which is at 45.23. And we closed this trade out at 45.25 as we speak. We're at 45.27. So emerging markets is hanging in there. And our new trade alert today is to reload our downside protection. We're still very bullish on emerging markets. And the new trade alert, if we scroll down, is to buy to open the January 31st, 44.73 put option expiring on January 31st. That's next Friday. Last week, we paid about 18 cents for downside protection. Because this virus is, number one, it is starting to spread from human to human. So that's a big scare factor. Two, it's now spread to Japan, Taiwan, South Korea. So it is growing. So I do think we could see some potentially more fear this week in emerging markets. Simply put, if everyone thinks they're going to get sick, all of a sudden travel comes to a halt in Asia, and that will have significant effects on GDP. Plus, at the same time, the protests in Hong Kong continue to get more and more angry. So that whole area is climbing a wall of fear, which is great for investors, especially like us, who are smart enough to buy a put option. So the basic bet on this trade, it's called the married put. And again, because this only represents 10% of our portfolio and emerging markets are trading at a discount relative to S&P 500 stocks, we don't want to short change our potential profit by selling the call. So we're simply buying the downside protection and expecting the underlying asset to appreciate at a faster rate than the cost of our protection. So again, we did increase the relative protection week over week by 50%. So we paid 18 cents for insurance last week. We're paying 28 cents this week. And I think that is smart considering this development. Now, the contagion started in December and has been slowly but surely exponentially growing. So we'll have to keep a close eye on this. If the virus does continue to spread and we do see the Fed's balance sheet decrease on Friday, next week I'll be willing to flip all our trades, even if it's for a short period of time, in the exact opposite direction. So that would be to bet down on stocks and up on bonds. Currently, we're not really positioned. We're very well protected against a downward move in stocks and an upward move in bonds, but we're not set up to profit from that. So I would want to see not only the virus continue to cause problems in Asia and to get worse and worse, but two, also for us to see the Fed's balance sheet decrease on Friday. So I'll try to have a decent prediction as to whether there's a likely outcome of decreased balance sheet come Friday by looking at the auctions today and on Thursday where all this debt's being sold. So that's a recap of our trade. If we go back up, first step again to exit the previous trade, if you did take last week's trade, is to simply sell to close your 45.23 put expiring Friday, January 24th. And we did pick up a 47% profit on the put, even though we did lose on the underlying asset. Again, that's our insurance. And essentially, we could have had emerging markets. Imagine this was worse. Imagine the virus was spreading twice as fast and stocks had sold off 3 times as much. Well, you could be looking at a $40 EEM ETF today, and the SPY could be well below that 330 put we purchased. So right now, investors haven't had a whole lot of fear for quite some time. And so I think you'll see our strategy to have put options hovering below our assets become smarter and smarter as 2020 progresses. So we would get a 45.23 price on our emerging market ETF, no matter how low emerging markets had gone because of that put option. And the only thing we'd really lose beyond that is that cost we paid. The new trade alert is again the 44.73. So because emerging markets has traveled slightly lower week over week, we're buying a slightly lower strike and also still paying a little bit more premium. Now, when stocks go lower, the relative cost of put options does increase. So that's just the way the option market works and our setup. So to profit this week, we do need emerging markets to travel up by the cost of the put to break even. And then after that, we turn into a profit. So you can see our break even is at 45.52. And our maximum loss week over week is at $80. So just under 2% of our total 10% allocation to emerging markets is at risk if we do travel below 44.73. That'd be our maximum loss, or 0.2% of our total assets are at risk over this week. On the upside, we have unlimited upside because we did not sell the call. And again, we're just hoping for at least a 28-cent bounce in emerging markets, which could happen in a heartbeat. And then after that, we go into the green. As far as where we're looking for emerging markets to head into 2020, 52 was the all-time high at the end of 2018, before all the central banks decided it was a good time to hike rates and vacuum money out of the economy with quantitative tightening. And this worked well for America for about 3/4 of the year, only to fail in the last quarter, as eventually at first crypto crashed, if you guys remember that, from 20,000, I think, down to some absurd 3,000 handle, losing 90% of its value for much of that year. Emerging markets followed next. The rest of the global stocks fell right after emerging markets, and then eventually US stocks fell 20%. And we saw central banks go into the opposite, where they began cutting rates. 2019 and 2020 is expected to be the great year of quantitative easing, as most of these central banks are now printing and buying up debt from their government. So that's a big picture. Another risk is that the Fed's starting to give us forward guidance that they may slow down debt purchases sometime in April. So I think we're going to have a very interesting time period when we approach April to see if yields have risen to the point where the Fed can really get away with not having to pick up so much US debt and add it to its balance sheet. So watching those auctions and seeing how much is going to primary dealers versus to foreign investors will be really critical to have some idea as to whether or not the Fed will really end QE or slow down QE around April. Until then, I really don't want to bet down against stocks almost no matter what comes out the gate. So that's why we're still long emerging markets as well as the SPY. Now we had a hunch Friday that we should play a little safer, over the weekend because we'd be having to hold that trade all the way through Wednesday. And it does look like that will be the right choice. Currently, the SPY's at 331.92. We sold the 333 and picked up the 330. If we do look at where investors are betting, let's give it a little refresh. We can see the 332 call option continues to dominate where holders of the SPY are selling call options. So $1.7 billion is sitting at that 332 strike. So we need a lot of buying power to push past that, pick up that block of $1.7 billion worth of SPY shares, and then blow into the next resistance level, which is sitting at that 135. Excuse me. Let me zoom in there. I guess I can't zoom in. 335 is the next. Sorry, guys, let me reload that. So we have two really, I guess we have three big resistance levels. We have $1.7 billion at the 332 strike. We have 1.7 billion at the 333 strike. And then at the 335, we have $1.2 billion. So combined, we need some $5 billion worth of SPY purchases to really gap up past those three strikes. So I really like where we're positioned on the SPY going in tomorrow, where we've sold the 333 and we bought the 330. Now, if we do go down to the put options, you can see not a whole lot of put option buying going on or underwriting, with only $677 million currently long that 330 strike on the put option, exactly where we purchased our put option. So that's where the big banks are willing to buy, again, $677 million worth of the SPY because they sold that 330 put. So the market's very complacent. Everyone knows we're dealing with rocket fuel from the Fed. And again, the only real fear would be foreigners picking up our debt and putting less pressure on the primary dealers. Okay, so that's a good review of our trade alert. I am going to be placing a daily video to you guys where I have more time to cover the charts. News it does take me several hours, usually about 3 to 4 hours of recording to put together around a 30 to 60 minute video that really condenses a whole lot of information into a short period for you. So that will go out in the evenings, regardless of which paid product you have. So do count on that. And this way our webinar can really focus on the trade alert, the big picture, and then Q&A. And that way you can enjoy the news in the evening after I've been able to collect it all, organize it, condense it down into a very well thought out presentation. Okay, so at this point, I would like to open up for Q&A and hear from the crowd. Shout out to Mark. He had a comment, Mark Stoley, to organize the trade up top to be a little easier to read. So we listened, and there you go. Hopefully that was easier to read. Let's go ahead and unmute the crowd and see what questions and comments we have. Some shout outs to members. Scott, Karen just joined the boot camp. Appreciate that. Guibo, Mark Stoley. We got Bob, MH, Donald Dickey. We'll be going over the Thinkorswim app in a moment here, Don, so that's good. Ed Danzo, welcome. Paul, we got a lot of people in here, guys. William McEely, Ron, Pete, Murray. We got the usual suspects and some new faces, so welcome. I'm going to go ahead and open up for Q&A now.
Hey, Jason, Scotty here.
Hey, Scotty, how's it going, bud?
Very good. Hey, I told this to Dean on the last hour Q&A, but read through, I got caught up on the boot camp modules, and I'm in position on the 4 boot camp trades. So I appreciate the one-on-one call time we had last Friday.
Oh, great. That's very good to hear. Oh, I did want to review our open positions really quick. And then speaking of those new positions you just picked up. So we're flat on the SPY, but I think the SPY is climbing a little bit. So we're actually up 70 cents on the SPY. So we'll be showing a profit on that as long as we stay higher. TLT, we gave up some of our profit. It jumped up several dollars. I do expect this will sell off this week as long as the contagion doesn't get too much worse. GDX is up 27 cents a share. And so that's our open positions. Okay, and Scott, I would love for you to share to the crowd sort of what we went over about how emotional trading can be, and kind of the big difference of what we're doing and how it can help investors, if you don't mind.
Yeah, that was a big part of our conversation too, huh?
Yeah, it sure was.
Yeah, some of the callers on that call just told some of their personal stories about their trading experience, and actually someone in the Q&A, a fellow New Yorker here, also opened up a little bit. So I'm in that group. Dean is in that group. You're probably in that group. And what this is achieving for me in terms of my goals long term is the consistent growth that we're seeing each week, the simplicity of it, and then the confidence that I have in looking at your track record. It's something that we publish every day. I went through my own daily performance tying out to what you had. And then the biggest piece of it is the macro view that you provide, which not only makes me happy just because I'm really interested in the financial markets, but it also gives me the confidence in the long-term strategy of what this program offers, and knowing that you don't have a single strategy, that you're adapting to market dynamics. I mean, there's a very specific global position that you have right now, and you lay out long-term and short-term visions for how that could change. So I know that this program not only has a proven track record, but it's also dynamic in terms of what future positions will change. So this is the only program I've been involved in that I see as something that will meet my needs for now and years to come.
Oh, thank you, Scott. And another important part was a lot of people are coming from other advisories, which they've come to learn weren't super honest and have caused a lot of pain for investors. And so a lot of people are thinking it was their fault for whatever reason. And I think after they've listened to our content and spoken to enough people in our community, that they're realizing, it really wasn't your fault. It was just the advisory was not what it claimed to be. It was hiding trades, sweeping them under the carpet, placing trades way too fast so no one could follow, selling when you're buying, and vice versa. So a lot of scrupulous actors out there have caused a lot of pain for people who are going into a period of their life where they're trying to retire or they are retired, and they've just given up a huge chunk of their savings following very bad investment advice.
That's another big part of it, Jason. Yeah, thanks for that. There's a YouTube video by a guy named Stephen Graham that breaks down a securities association study. I can't remember the name of the body, but it's a study. 80% of retail investors lose money, significant money, then another 15%, just stay about where they are. And there's only about 5% that ever make money. I've probably been since the early 2000s a part of, I'd say, 24 services that I think all 24 are out of business.
Yeah.
So they fall into the camp of the 80% that lost money. So whether it's following them or following books, all the energy and effort that I put into it is just mounted to big losses. And it all has to do with, it to your point, the shame that comes with, or the guilt, or whatever you want to call it, that comes with losing. It was set up to lose. It was high risk, and high risk means it was set up to lose.
Yep. Well said. We got a comment from Guibo. I think you can make more money using a trend follower system. Can you find a good trend follower system that does not need to trend? That's a good way to lose more money, for sure. So I think what you just quoted, Guibo, goes against the grain of every great investor of all time. So trend following works for a little bit until the market dynamic changes, and then that's the recipe for buying high and selling low. So I'll just leave that at that. Now I will mention for folks in our program, we are going to be providing a daily video in the afternoon, which will also provide the same strategy without the options. Now, what's the catch? So the catch is that it's riskier, and that does entail making larger profits. But again, when the trend changes, strategies that don't have this downside protection we have are going to eat a big loss. So for those of you who, whether you want to put your whole portfolio or part of your portfolio into a little more passive strategy, definitely watch that daily video, because I'm going to be showing, as you know, as we've seen, our strategy with the options requires extreme accuracy in predicting markets, because not only do we have to predict the direction of these markets, we have to pay off the put protection on every single trade. So to pull off these returns requires very good macro predictions. So for those of you who do want a little more risk with less work, just watch your daily video coming out. I think you'll see that is another way to follow the program. Okay, Mark has a question. Jason, aside from seeing the need for this service, is there other reasons you and your partners decided to start this program a year or so ago? Sure, great question. Yes, let me give you a little bit of my history. I started in 2009, right after the stock market had crashed. I was a marketing guru and had this guy fly out from New Hampshire. And, he told me, well, he opened up his Ameritrade account. He had pulled off 12,000%. That's not a typo. 12,000% returns buying some super out of the money long put options on the QQQ ETF. And so he had, like $52 trades that had pulled $10,000 profits. And he flew out to my office and wanted to partner. He loved all the content we're putting out about how to essentially just set up your website. And he wanted us to help market his service. So I was interested. I really didn't know much about stocks at that time. And he had suckered me into buying, well, he didn't sucker me into it. He told me he had friends in the government and America was going down from there. So my first trade alert, going back to what Scotty was saying, I think I put 25 grand into a put option in 2009. So I lost 100% of that. If we'd done the opposite of this fellow, would have done very well. So that was my introduction into finance, was meeting this guy who was a perma bear. From there, after selling his advice as a consultant and seeing that he was 100% wrong because he only bet in one direction, it really opened my eyes to this industry. And I went on to work with just about everybody you can imagine. Some of the names I see mass marketing these days, if you've seen that Bond Picks, he's in his airplane flying around. We sold quite a bit of his services. Timothy Sykes, Chuck Hughes, Matt Hedge Fund Trader, the list, just about every mass marketed product you can dream up of. They came to me to sell their program first. And, they're bragging about all these profits. We're selling tens of millions of dollars worth of this service. And so I'd send the marketing team out to go collect testimonials. And the oddest thing would happen. Jason Bond, Raging Bull. Yeah, don't buy that product.
Mark was just saying I lost a lot with Jason Bond Raging Bull products.
Yeah. Yeah, not a good idea to buy any of those. So anyways, we send out the marketing team, hey, go get us some testimonials. I mean, these guys are reporting crazy returns. You know, we sold $10 million worth of product in 2012 alone. Where's all the testimonials? Couldn't find a testimonial to save our life. So I began questioning what on earth is going on here. And so there's a whole laundry list of reasons why. Now, sometimes the guru was really scrupulous and not ethical. Oftentimes, the product was just created in such a way that investors could not get the same result. So while I would like to say sometimes it was just bad actors, sometimes the way they wanted to issue their product was just too hard to follow. So after quite some time of dealing with this, trying to coach these trade, I was studying their products, their trade alerts, their systems, reading a book or two a week, digesting everything I could. I'd start to try to give them feedback about how to organize their product to be easier to follow. And long story short, these traders are very stubborn people. They do not want to change their ways. A lot of them are older, so they're not very good with technology. And they really just don't give a damn. They're going to do what they're going to do, and that's that. So eventually, I realized that there's a handful of big problems. I could probably spend 2 hours just talking about all the problems, but long story short, we've solved those problems. And I think the key things that we're focusing on is, number one, most people who do end up buying these products tend to be either near retirement or in retirement. And that single fact alone instantly needs to change your mindset about investing. Because the second you don't have a new source of income, you just cannot afford to realize large losses. And a lot of people are like, well, I don't mind losing a little because I'm going to make it back. But that takes you down the bunny hole rabbit into a dark place very quickly, because you lose, say, 5% in a week. We just talked to a guy with $1 million account who lost 6.5% in a day on Tesla. Okay, in a day. So you lose 5%. Well, now you're in this mindset, oh man. And if you're the gambler type, that's really who gets killed here. Yeah, this is who really gets hurt, is the gambler type mindset where you lose 5% and you don't instantly get shocked. I've noticed Dean, if Dean loses a little money, he's out of the market. I mean, he is out like trout so quick. And that's probably why he's done very well over the course of time. It's because he hates to lose money. He hates to even spend money. He's bragging about his $20 jacket from Costco just the other day. But if you're the mindset where if you've lost 5% and now you need to make it back, so you're going to take on even more risk, and then you lose 10%, and now you're down 20. That's how people blow out huge retirement accounts in a mere matter of weeks and months. So right there, that is the crutch of the problem in this entire industry. So if I had gone back in time and showed myself this product trying to safely generate 1% a month, I would have laughed at myself and politely showed myself the door. So at the end of the day, this product is not what the market necessarily wants. It's what the market needs. And so that's why we come up with this product. We've been fine-tuning it. We've been learning where's the discrepancy in our portfolio versus the client's portfolio, and how do we bridge that gap so we're all getting the same results with the same precaution. And so by having a designed trading plan that trades the same asset on the same day with the same ratio of stocks, we have officially solved the problem that the guru gets a different result than the client. And that is a big breakthrough for this industry. We're really proud of what we've put together. And sometimes that means we got to jump on the webinar and talk about how we lost What did we lose together today, guys? We lost 57 cents together today. But it's critical that we all lost the same amount and are not having different results. And so that is really why I designed this product, pulled together our team, and we're not out mass marketing this like we have seen with other programs. We're not using fancy sales letters predicting some huge thing's going to happen in the future. No, we're just doing nice, boring trading plan that is super safe, conservative, and understands that because our clientele does not have a new source of income, they're absolutely crazy to make outlandish bets, because if they're wrong, they're going to go down that dark hole where, all right, I lost 5%. I need to double down. Uh-oh, now I lost twice. Now I'm down 10%. And so the story unfolds if you trade the markets that way. So yeah, we came up with the most boring trading strategy, the safest assets, and we got to pay off put options every week. But at the end of the day, I think you guys will see, especially when the market's not so kind to buy and hold investors, I think that's when we're really going to see our strategy is so much more sophisticated and intelligent for investors who can't afford large losses as we go into 2020. And I really think around April or May that everybody who's had a good run is going to see that's short-lived as the Fed does try to slow down the growth of its balance sheet and try to get the foreigners to pick up our debt and protect the dollar, obviously. Okay, great. Next question. And that was a great question. I'd love to address that question. William, I see your hand's raised.
I have I have a question about how to maybe it's because I only have this 75,000 invested. I'm just not seeing the 1% increase. I know Dean usually talks about 300,000, but I've only been in it since December. And
okay, sure. No, good question. So, okay, let me address that. So the percentage doesn't matter how much you've invested. It's just relative to the total return. So I do want to point out that from September through December, you can see we've had less than 1% return outside of December, which I did note to you guys that I put in all our dividends for the year in December. I'm now adding the dividends on a monthly basis. So we basically had very good returns on the SPY over that period of time. But because the trade war was not resolved and had a risk of escalating, we had to remain long the TLT, that's the bond market. And that was our method of protecting capital in case the trade war had escalated. Now, if I had just bet that the trade war would not escalate, we could have had substantially larger returns, but I would argue that would have been a foolish decision with our audience. We're not in the period of time where we should be speculating on something that for 2 years had not had any progress. So we did see the TLT eat away a substantial amount of our profits from September through December. Now in January, we're currently up 0.4%. So you should see in January so far a total return of 0.4%. And once again, if there is a big risk right ahead of us, our go-to strategy is going to be long the SPY and long the TLT at the same time. And that TLT acts as our relatively cheap insurance to protect our assets.
Hey, and William, so I was actually just talking to another gentleman yesterday that had generated about a $4,000 profit starting from, I believe he was fully balanced the first week of January. January 2nd was the first week of full balance, and he was up a little over $4,200. I want to say he was about 300,000 to 400,000 in capital. What was the day you hit full balance with the portfolio?
The first week that I was in, so that would have been the first, when I signed up that week is when I put in the full balance.
Okay.
And from, let's see here, I've been trying to keep records, starting on the, let's see here, I had, on the 6th, I wrote down that my equity was 75,398. And as of today, I'm 75,191. So I'm down $191 since the 6th of January. And I just, that's why I asked the question, because I'm just keeping a running total. And I write down the number at the time I make the trade. So
Okay.
it's not.
You know, William, so I don't think you're following the trades properly. Can you send us all your trading activity from the 6th until today? Just email it to support@Portfolio Builder, because something's wrong.
Because I followed the trades exactly to the minute that they come in. I put the trade in within 5 minutes of when you announce it. And I've been doing the market instead of limit, so they go through immediately. And
Yeah,
so I didn't know
completely different results from me and all the people I've talked to. But send us your trade records. We'll be happy to take a look through that.
So how do I do that? Do I just go into Thinkorswim and?
Yeah, just call them and say you want to get all of the trading activity from the 6th till today, and they'll teach you how to do it. And then just email
Okay.
it over to us.
Okay. All right. I'll do that.
Thanks, William.
Okay, Mark says he's up $1,892. Very good. So yeah, guys, we had, just to be completely fair, here's really the only place we've been really having a little bit of drawdown is right here, this stretch, where we're long the TLT. But again, I would not, even knowing what came out of that, I would not change the way we traded October through December. Because if you really thought that the trade deal was a guaranteed surefire thing, then you've got knowledge that every great investor in the world did not have. And most of the top hedge fund managers played it the same way we did and had very similar returns. So we had a little drawdown October, November, December in the TLT position. But we've had very, very good returns on the SPY during that period. So to a degree, they did offset each other slightly, but you should be up if you are following the trades accurately in January. Friday, we were up 1%. Today, we're up 0.4. The TLT did go against us over the weekend because of the virus scare. But I do believe that unless that continues to get out of hand, that we'll see that TLT pull back this week. And I do intend to do the same trade for the TLT on Thursday. Mark Stoley says, since the 12th to the 30th, I've been on 800 SPY shares, and he's currently up $1,892. Great. That's excellent. Let's see. Murray, you got your microphone today. I always like to hear Murray's comments on the news. Let's see. We got Paul, Pete, Ron. Any questions or comments today? Karen, we haven't heard your voice yet, or at least since I hopped on.
Jason, they must have all gone to sleep on you.
Yeah, they want the second news piece to come out. That's what Murray really likes.
Could be. This is on, and for those that are listening, I'll kind of tell you how I've progressed in this so far. And
Okay.
I'm a very skeptical guy, so I kind of take baby steps. But I started sometime in November, and through November, I lost money, lost about 1/3%. And I just track I track it by the week, but then I do a monthly end up, so I can see if I can kind of balance with what you're doing. And then December, I made up my November loss, and through last Friday, I'm up 1.5%,
Nice.
which I thought was pretty good. Of course, last week was a pretty good week, but I did vary a little bit last week because, and maybe this is just the trader in me, but I kept hearing you talk about the TLT and it's going to go to pot, and I said, why do I want to keep this and hedge it? So I just dumped my TLT. So I didn't take those losses last week.
Oh, okay.
So that, but I'm back fully.
Yeah, right now the TLT is not providing the type of value it did in Q4 of last year, because we're short the TLT because it from our measurement it is too expensive. It doesn't provide the yield we need to want to be long that asset as insurance. So the upside potential is outweighed by the downside risk without a major fear to scare the markets.
Right. Well, that's kind of the way I felt about it. And when I sold my TLT, I thought, maybe, just listening to your analysis and all, maybe I need to take that cash and do emerging markets. I did not do that because I'm going to force myself to stay with the program as designed. I think it's a good one. Anybody that sits there and says they're not particularly happy with 1% a month, maybe they grew up in a different world than I am. But I'm going to tell you what, if you can consistently make 1% a month and not lose, you can't go wrong, guys. You just cannot go wrong.
Yep, it's a good return.
It's a very, very good return. You listen to some of these other guys and they're talking about, 3 or 4 or 5%. That's BS. They might do it a month or two, but not consistently. They can't do it.
Well, they can't do it without having losses the same size. Usually what you'll find, what I've noticed is that over the course of time, if you're aiming to make, let's say 5% a month, you're going to end up risking 10% to get there.
Or more.
Right. Yeah. Or more, depending on what you got yourself into there. So that's just the name of the game.
Well, and of course, timing is a lot of stuff. I had lunch with a guy yesterday, and he retired in the early part of 2009, and he put all of his retirement money into the SPY. And he kept sitting there preaching to me. He said, I don't care what anybody says. He says, just buy the SPY and sit back and enjoy it. Well, since 2009, a well-trained monkey on a stick can make money. I mean, it was pretty simple, but, and he doesn't hedge. I got to talking to him. I said, don't you ever hedge it, Rick? He said, no. He said, I don't want that expense. And I said, well, what's going to happen to you when, what happened to you in December of 2018? He said, well, I lost my butt. And I said, well, I understand that. But he said, I made it back. And I said, well, yeah. But
this
how much
time
do you have to make back to recoup what you lost? So, I guess what I'm saying, this program to me is probably one of the better ones that I've seen. And I've looked at a lot of them. I've done not anybody else's program. I used to be a dividend guy, and then I switched over and I started doing cash secure puts. Both of those have a lot of risk in them, and you don't even realize it.
Yeah. Well, you don't realize it till it's
You
too
lose.
late. Yeah, till
till
it's
you
way
lose.
too late. Yeah.
So, like you say, if you're retired or approaching retirement, you can't afford to lose money. You know,
Well, very well said, Donald. Very well said.
Thank you,
I mean,
Donald.
that's just my point of view, and I'm not the smartest fish.
Paul Tudor Jones had a quote today comparing what we're doing with monetary policy and the government spending to something as crazy as 1999. And so in the 5 months leading into the dot-com crash, the stock market, I believe it doubled before it went on to tank and give up all those profits. So
Yeah.
yeah, we got to have a strategy that doesn't allow you to just get completely hammered when things aren't so groovy like they are right now.
Well, I can tell you in 2008, I lost 50%.
Yeah. Now, if you'd had the TLT, you wouldn't have done that.
Well, no, I was with a money manager, which I would never ever do again as long as I live. But
oh yeah, who was the money? Was it a big firm or a little boutique or?
No, it was a big one. Edward Jones.
Oh, okay. Yeah. See, they have a rule that these guys all have a rule, and it's never sell, no matter what.
I understand that.
Yeah, they don't get paid the commission on telling you to sell, you know.
Right.
Well, the bigger problem is they could create a stock crash just all on their own, and that's the last thing they want when they're managing so much money.
For sure. Yeah, I mean, if they just popped out of St. Louis and told all their guys, I mean, they've got 1 million of them, hey, tell everybody to sell. I mean, they'll crash the market.
Oh yeah.
I mean, they'll flat crash the market in a day. So,
easily.
But like I said before, if you can consistently, safely make 1% a month, you're going to do awful good. You really are. You know, Dean, when I was first talking to him, he said, you know, Don, he said, the biggest problem I have is a lot of these guys are not happy with 1% a month. And I thought to myself, they got to have their head examined. They just got to have their head examined to consistently make 1%. I mean, averaging that, you know, a guy can always say, well, I can average. But yeah. How many stay with it when it drops 50%?
Yeah.
I can tell you, I didn't. I cut and run.
Yeah, it's hard to hold on to a 50% loss. Well,
Yeah,
but you know, we really have two mindsets I've noticed over time. One is very scared. They'll sell the second they have a loss and then miss the next move.
Right.
And then the other is the risk-taking type who hates to take a loss and will double down when they're losing, which is by far a more risky trading type personality.
Yeah, I've done that.
Yeah, you can get hurt in either setup. So there's no. But yeah, some people like to. There's something funny about not wanting to take a loss, and thinking if they hold on to it and then let it go back up, then it's going to work out all right. And they don't want to change their strategy until they've made up the loss on whatever bad investment they're holding. And so, so that's the most dangerous mindset I've seen by far. I guess it's your gambler mindset. But the other is the opposite. You take a tiny loss and now you're out, and you're going to go back to cash and sit there and just be scared and let your money lose its value. So that's not good either.
No. Well, you know, they say there's still a lot of people that got out in 2008 that are not back in yet.
Yeah, I was just talking to a gentleman out of Wisconsin, Donald. He's got probably 8 figures sitting in cash, and same thing. He lost millions and millions of dollars in 08, and he said he's been scared to go back in. He said, well, he said, shit, if, if everything goes wrong, a week after we do this, I'm going to be, I'm going to have a bigger account unlike I did last time. And, the guy was just telling him, don't sell. So he finally wrote a guy, an email and said, hey, take me out of everything. I'm no longer your client. And just wild. And it's just so weird that they don't structure any type of downside protection. They just let the fall happen to you.
Yeah, very true.
It's not fair.
Mark Stoley has a question. I keep hearing of a pending melt up like 1999.com. Boom. What do you think of that? So Paul Tudor Jones, famous investor, used to work with George Soros. And so he's out there trying to pitch his, he's always out trying to pitch an ETF he's created where I think it's an eco-friendly ETF or something like that. But regardless, he was saying the twin deficits, when we look at the government spending and then the Fed's balance sheet and the rate cuts all happening at once, that's what he's saying. This is like the 1999 .com crash is what he's concerned about. And so that's really our big thing we're looking at is what's the cause of all this? Well, step one is the government's 2-year budget. So that's set in stone. We've already got it laid out for 2 years. And there's well over $1 trillion that we can't afford in our budget for the government. So we start there. That's the first place you got to start. And so we can keep close eye on the debt issuance right here on this website. Now, typically they're doing the bonds, which we trade in the TLT at the beginning of the week or of the month. And they're going to add a 20-year bond where it was just the 30-year previously. So they had taken off the 20-year, I guess about 25 years ago or so. So if the government's creating debt that it cannot collect from tax receipts, who's going to buy it? That's the next question. So by law, our JP Morgans have to pick up that debt. Now, if they can't sell it, that's going to create a liquidity problem. And that's when you heard the repo madness, you saw the yield curve invert, big problems for banks, big problems for hedge funds. Now they don't have access to loans to use their long bond, long equity strategy. So just about every big hedge fund out there relies on this idea that they can leverage into a stock bond portfolio and have almost no risk. So that's what they're all relying on. And so right now, the problem in the markets is the debt. We have too much debt, and the yields got so low from the US-China trade war that it's not worth it for a lot of the yields, especially on the front end of the curve where we've pushed that yield down to 1.5. So there's less demand for the bulk of our debt, and the bulk of our debt does sit here in the T-bills and not in the notes or the bonds. So most of US debt is revolving very quickly. So it's expiring in 4 weeks, 8 weeks, 13 weeks, 26 weeks, 52 weeks. I'll get us a breakdown tomorrow of just what percentage. So the Fed has come in and said, all right, we're going to support the government by picking up this debt. And so they've been averaging a growth of their balance sheet. When you add up all the different factors, it's growing by approximately $100 billion a month. So go back to that story. Well, if we have 10 stocks in the middle of our little group here, and collectively we all have $100, well, those 10 stocks got to be worth $10. But if we suddenly double the money supply and our group has $200, all those stocks must be worth $20. So that's the very simple calculation that is fueling the stock rally right now. So really, the funny thing is, the big thing that could stop the stock melt up would be if foreigners become attracted to U.S. government debt. And as the yields, and we could see the reason they're issuing that 20-year bond, now the banks are signaling that the Fed's going to do the current QE until April. And at that point, they're going to switch over to buying debt on all parts of the curve. So to me, that basically says, all right, we need to get yields higher so we can sell this debt to foreigners and relieve pressure on the banks. But we can't let the yields get so high and attractive that it crashes the stock market. So they're trying to do this tightrope act where they do allow the yields to rise so that the debt's being sold to foreigners and not to JP Morgan. But the catch is they know if that yield goes up too fast, it'll crash stock market. So that's the big risk. And can they pull this off? We'll see. But that's their plan. That's what they're signaling, is to focus on the front end of the debt for the next 4 months, and then to try to stop the yields from rising too fast as they see foreigners start to pick it up. So that is quite a balancing act that they're trying to pull off this year. And that's what all this market melt up's all about. So when we see the coronavirus causing a bid on the treasuries, which is represented by the TLT popping up today, to me, that's an alarm signal that, the government may have successfully sold its debt this week to foreigners, which means we're not going to increase the money supply this week, which means come Friday, people who are just sitting there watching the money supply grow to calculate the value of stocks could have a letdown. So that's my main concern. Anytime we see the bond market have a bid, the US bond market.
And that's why you always pay attention to the financial system, baby. Great work, Jay.
Oh, we got to fix Karen's name. We'll get that fixed, Karen. Let me get that. I think Ryan's probably listening. So
Hey, Jason.
Hey, Scott.
You talked about that those in the industry are counting on that mix of equity and bond. My company changed the 401k where starting this year, it took all my positions that I had out, which weren't much anyway, but I told you I look at the SPY option and there's a bond option, and it moved all of us, the entire company, into a bond equity mix based on your retirement year.
Yeah.
So it had me retiring at 2025, and that's only 5 years away. So you can imagine the bond allocation in that mix was heavier weighted. So what I love about this service is I know that it's got me positioned in a mix that I don't want. So I'm digging into what my other options are. But that's just another reason I really like your market outlook, is that, like you said, how the industry has this system that they count on. Well, it looks like the industry is putting the same thing in my 401k, and I don't want to happen to me what's happened to me in the past.
Yep. Yeah. The whole system's engineered this way.
I've seen that happen with these 401ks. It's kind of interesting because some of these companies are reducing their costs. And so they're reducing the amount of exposure to different types of funds that they're offering. I've seen that happen. That could be part of it, and it just could be they don't want to be responsible for anything that people do wrong. I've seen both sides of it. I know when with my old employer, they expanded it like crazy, and with my husband's, they contracted it kind of like yours. So. But with my husband's employer, that was a whole nother issue. These guys took money out that they said that wasn't owed from 2 years ago, and the only one that caught it out of thousands of employees was me. And I said, "Where the heck did this money go?"
Right.
And they've gotten audited, and we're still waiting for it. And they say, "Oh yeah." I mean, so a lot of these companies and the way that they manage their 401ks, it's miserable because they have to expose and they have to disclose all of their fees now, where they never used to a long time ago. So it's been very interesting to watch them as they're jumping around and and trying to navigate really the legal quagmire that they're in the middle of, and they hold their costs down. It's unbelievable. So good luck with that.
Yeah, cookie cutter wealth management. That's what the whole world's
Exactly,
suffering
Scotty.
from right now.
Maybe reach out and see if there's a self-direct option, Scotty.
I like that, Dean. I will.
Okay.
All right, guys, I'm going to go ahead and wrap up today's webinar because we do have our boot camp coming up in 50 minutes. This is a special edition. It shouldn't last too long. We're just going to walk you through how to place the trades from the Thinkorswim phone app. This is part 2 from last week. If you didn't watch last week's, it's good. Even if you're experienced with options, I think you'll find value with that 2-hour video where we went through quite a few different variations of our trades and looking at the effects of different spreads in the strikes, different durations. And so that was a good video to watch. That was about just under 2 hours. Today's will be much shorter. We're going to just give you a very simplified way to understand how to place these trades from the Thinkorswim phone app. Next Tuesday, we begin a deep dive into call options. So we're going to know more about call options and how they react to volatility throughout history. So I think that'll probably come in about an hour. I'm going to try to keep them a little shorter. I think 2 hours is a little bit long per module. So we do have the Thinkorswim module today. Next Tuesday, we will have the next module 5, where we start to do the deep dive into call options. So, and also expect a daily video in the evening, which goes out to all paid members, where we're going to cover the detailed charts and news. I was trying to cram that into the webinar, and it just takes my attention away from the trade of the day. So I really prefer separating those 2 pieces of content. So I think we'll all enjoy that. And that way you can just focus on the trade alert in the webinar, and then you can focus on education in the evening. So thank you guys so much. Any final comments, Dean?
No, I think I'm good. Kathy, I know you're new. Do you have any questions, Kathy C? Let's see here. Who else do we have that's new? Pete, any questions for you, bud? Please feel free to jump in.
Let's see. DD has a question. He got in late. If you do go back to your email after this is ended, click that link and it will replay today's episode. So you can always go back to your email, click the same link, and it will replay your episode for today.
Okay, cool. And shout out to Perry there. I see he got the full allocation. He's doing 300 of the SPY, 600 of everything else. So great job on that, Perry. Anyone else? Any questions, guys, before we go here? And if you're just on the service, and if you want to join the boot camp before we start our module today, just call me. I'll be happy to get you set up to do that. Okay.
What time are we starting the boot camp?
45 minutes.
Okay, give me time for lunch. Thank you.
Yep, same here. Okay, it's been my pleasure as always. Really appreciate our group. We've got a great group of you guys. I really enjoy talking to you every day. So thanks for joining us live. And I'll see I know a lot of you are now in the boot camp. So we'll see most of you guys in about 45 minutes. If you can't make it, it will be recorded. So no stress there. And tomorrow we'll close out our SPY trade. We're up about 80 cents on that one before you take out the option collar. So we're probably up good 60, 70 cents right now on that trade. GDX is hanging in there. And now we just want that darn TLT to pull back this week, and we should have a very nice return. So that's where we're looking so far. Okay, thank you guys so much. The boot camp is automatically sent out to all the boot camp members. So I don't know if you are part of that or not yet, DD. I'm not sure. Let me see if I can recognize the name. So yeah, we do give out a 30-day trial to anyone upgrading their advisory service for the boot camp, but that is a separate product.
Yeah, and Dee Dee, I'll send you the recorded version as well, and a link to the YouTube video. Just that way you can subscribe to our YouTube channel. Oh, there you go. Ryan just posted it to you actually, so everyone can actually see the link to the recorded version. And what it does is it'll actually take you back to just the very beginning to our YouTube channel. And then definitely, Dee Dee, make sure to subscribe to our YouTube channel, and you can post any questions you have as you watch the recorded version, and we'll respond to them when we can. Okay.
Sure. And now the boot camp content is privately hosted on Vimeo, but
Right.
you can catch the replay through these private links on YouTube. So, okay, great guys. Really appreciate it.
Okay. Perfect.
Thanks as always.
Thanks, Karen. See you in a little bit.
Okay, bye.
All right.